Have you ever wondered why so many revolutionary hardware companies, the ones that make the gadgets that literally change our world, end up being such terrible investments? I mean, think about it. Year after year, they give us faster, cheaper, more amazing technology, but they just can't seem to make their investors rich. It's a huge paradox, and it sits right at the heart of the modern economy.
Welcome to another video on Investment Basics by Mr. Majibut. Today, we're going to tackle this exact problem. We are going to dive deep into the incredibly tricky world of investing in hardware companies. We'll unpack why it's such a minefield, and this is the important part, how you can spot those rare gems, the companies that actually manage to build lasting value. So you'll definitely want to stick around to the end because I've put together a summary checklist for investors that you can use for your own research.
All right, let's get into it. Here's what we've got on tap. First, we'll look at that hardware paradox. Then, the forces that drive this industry. We'll talk about the dangerous cyclical trap. After that, we get to the good stuff, building an economic moat. We'll cover what a real winner looks like, and finally, we'll hit that investor checklist I promised.
Okay, so let's start right there, with this fundamental conflict. It turns out, the very thing that makes the hardware industry so incredible for us as consumers is the exact same thing that makes it a brutal, unforgiving place for companies and their investors.
I mean, you and I, we love this, right? We get faster speeds, lower prices, more features year after year. Just think back, a computer in the late 90s with a Pentium 2 chip cost, what, over $1,500? A few years later, you got way more power for less than $1,000. That is awesome for us, but for an investor, it is an absolute nightmare. Those lower prices mean insane price competition, which leads to margin erosion. And those faster speeds, that creates these brutal product cycles where the brand new gadget you just made is basically obsolete in months. Your inventory can become worthless just like that. Almost all of the value gets passed right along to the customer, not the shareholder.
So what's powering this relentless machine of progress and, well, pain for investors? It really boils down to a few key forces that you absolutely have to understand if you're going to play in this space.
And at the very core of it all, you've got Moore's Law. This was an observation made by Intel's co-founder Gordon Moore way back in 1965. It's pretty simple. The power of a computer chip basically doubles every 2 years. But here's the kicker for us as investors. The cost for each little piece of that power, each transistor, falls off a cliff. This is the engine that guarantees the computer you buy today is old news in a couple of years. And it's why the value of that incredible innovation goes to you, the user, not the company's bank account.
Now, Moore's Law is the big one, but there are two other things feeding the fire. First, our economies are shifting from making physical stuff to providing services. And service businesses, think law firms, design agencies, they need way more computing power per person than an old-school factory. Second, you have this perfect loop between hardware and software. Amazing new software demands better hardware to run it, and better hardware lets developers create even more amazing software. It's a cycle that guarantees growth, for sure. But, and this is a big but, it doesn't guarantee profits.
And that brings us to maybe the biggest hidden danger for anyone investing in hardware. The demand for this stuff, it's not a nice steady line going up. Oh no, it's a violent, stomach-churning roller coaster of massive booms followed by devastating busts.
So here's why that is. The biggest buyers of hardware by far are other companies. And when the economy gets a little shaky, what's one of the easiest big purchases for a CEO to put off for a year? That big office-wide computer upgrade. They'll just try to squeeze one more year out of the old machines. And just like that, IT spending gets slashed across the board, making demand for new hardware incredibly volatile.
And you can see it perfectly on this chart. That smoother line at the bottom, that's just general business spending. It goes up, it goes down. Now, look at that crazy, jagged line. That's spending on computers. When times are good, it skyrockets. But when a recession hits, it doesn't just dip, it absolutely falls off a cliff. As an investor, trying to guess the timing of these swings is just a recipe for disaster.
This roller coaster leads to another massive trap, inventory bubbles. Here's how it works. During the boom times, companies get super optimistic. They crank up production, ordering tons of parts. But when the bust hits, and it always does, they get caught with warehouses full of product that's losing value by the second. This quote right here is a huge warning for you. If you're looking at a company and you see its inventory is piling up way faster than its sales, that is a giant red flag. They could be heading for a massive write-down, just like Cisco did after the dot-com bubble popped.
Okay, so we've laid it all out. The hardware industry is a total battlefield. You've got intense competition, you've got brutal cycles, you've got falling prices. So how on earth does any company survive in this environment, let alone thrive?
The answer, my friends, is by building what we call an economic moat.
Now, if you take away only one thing from this entire discussion, please let it be this. Having the fastest chip, the sleekest design, the coolest new gadget is not an economic moat. Not even close. In hardware, a tech advantage can disappear overnight. For every successful company like Dell, there's a whole graveyard of forgotten names like Packard Bell and Commodore. A real moat isn't about having the best tech today, it's about having a durable business advantage that competitors just can't copy.
So what do these moats actually look like in the real world? Well, there are 4 main types. First, you've got high customer switching costs. This is where it's just too painful or risky for a customer to switch to a competitor. Second, being the low-cost producer. Think of Dell in its heyday. They could sell a computer cheaper than anyone else and still make money. Third, intangible assets. This could be a super powerful brand, critical patents, or some kind of secret sauce in how they design chips. And finally, you've got the network effect. This is where a product, like Cisco's routers, becomes the standard simply because everyone else is using it, making it more valuable for every new customer.
All right, so we know what a moat is in theory, but how do you actually spot one out in the wild? What are the telltale signs that a company has a real durable advantage? There are 3 big things to look for.
First, look for durable market share and consistent profitability. A company with a moat can defend its castle. They stay profitable even when the whole industry is in a downturn and their rivals are losing money hand over fist. Second, they have a laser-like focus. They know what they're good at and they stick to it. They don't get distracted by shiny new objects. And third, they have flexible economics. The best companies are nimble. They can ramp costs up or down quickly to match that crazy cyclical demand. A great sign of this is when a company outsources its manufacturing.
And now, let's bring it all home. This is the part we've been building towards, your actionable investor checklist. This pulls together everything we've talked about into a simple framework you can use to analyze any hardware company.
All right, first up on the checklist. Information technology is an increasingly important source of productivity in advanced economies. So what does this mean? It means there's a massive long-term tailwind blowing in this industry's favor. Our economies are only going to need more and more computing power. This is the fundamental opportunity.
Number 2, technology innovation means that hardware firms can offer more computing power at an increasingly cheap price. Thus, IT can be applied to more and more tasks. This is Moore's Law in action. As tech gets cheaper, it spreads everywhere, from data centers to our coffee machines. This is what creates the growth, but remember, it's a double-edged sword, because it's also what creates that brutal price pressure.
Okay, number 3. Because of rapid innovation, technology hardware companies tend to generate rapid revenue and earnings growth. And this right here is the bait. This is what gets investors so excited. You see a company's sales doubling every year, and it's easy to get swept up. But now you know the critical question to ask is that growth built to last, or is it just a flash in the pan?
At the same time, competitive rivalry is often strong in tech hardware. Moreover, demand for technology hardware is very cyclical. This is your reality check. You always have to weigh that shiny growth potential against these 2 giant headwinds. The competition is fierce, and the boom and bust cycle is always lurking. Never, ever forget that.
Number 5, and this is the big one. Technology by itself does not constitute a sustainable competitive advantage. Hardware companies that develop economic moats are more likely to succeed over the long term. I can't say it enough, this is the golden rule. You have to look past the flashy product and the impressive specs and find the deep, structural business advantage that will still be standing in 10 years.
Number 6, examples of moats among technology hardware firms include low-cost producer, Dell, intangible assets, Linear and Maxim, switching costs, Nortel and Lucent, and network effect, Cisco. So, use these 4 categories. When you're researching a company, ask yourself, which one of these boxes does it check, if any? Can it lock in its customers? Is it the cheapest? Does it have a secret sauce? Does its network create a standard? And finally, number 7. A company with a sustainable competitive advantage should be able to effectively fend off its rivals and maintain significant market share and/or sustain above-average margins over an extended period of time. This is the proof. The proof is in the numbers. A real moat isn't just a good story. You can see it in the financial statements. Look for that stable market share. Look for those healthy profits that hold up even when things get tough. That is the ultimate sign of a real winner. So the next time you see a hot new gadget, don't just ask what it does. Ask yourself, what's the moat?